You're in the Business Insurance Zone with me, Steve Savant, syndicated financial columnist and contributor to Backroom Technician. This week on the Biz Income Tax Planning Series for 2013, and on today's show, the AMT, Capital Gains and Losses with national columnist, certified financial planner, and CPA, Ken Davis.
When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Well, welcome everyone to the Business Insurance Zone. I'm your host, Steve Savant, and we're broadcasting live to a nationwide audience of financial advisors right here in Fountain Hills, Arizona, home of America's largest fountain. And with me today, not only does he have a certified financial planner and he's a CPA, but he's also a CLU and a CHFC. You know him as your CFP, Ken Davis.
Hey,
Ken.
Steven.
You know, Ken, I had Ken on my television show. You know, we're talking about taxes and everything. We're talking about it today for our producers. You know, we've been doing this all week. And next week, I think we're going to try to do something really off the rails. I'll talk to you a little bit about that on Friday's show. When we're talking about the AMT, finally, we got some legislation and some relief here. It hasn't been marked to inflation for how many years, Ken? I mean, that went on forever.
It's crazy, and it drives me crazy because people can't plan. I mean, we're supposed to know before the year starts what the tax law is, and instead we're really down to the very end of the year before we actually got any guidance as to what's happening.
Well, we didn't have it for, I mean, how long did we go with the AMT without having any kind of inflation?
Yeah, well, many years, and they kept putting a Band-Aid on it year after year after year. And my theory is, right or wrong, is that Congress didn't want, when they're doing their projections of deficits, they wanted to include this phony income because technically the law said you didn't get, you know, the exemption at the higher level, and they could then forecast higher taxes. Well, now they've made it permanent, thank goodness, and they can't play that game, at least with the budget going forward.
Well, when I think about the AMT, it's been punitive for middle class. I mean, this was really created for rich people, for wealthy Americans, and because we didn't have inflation maybe over a couple decades, I don't know how long this has been going on, but really, we were paying, so many people were paying AMT, and it wasn't targeted for the middle class.
Right, and one of the things, you know, is the fairness of the tax law, and when our politicians stand up and say, this is to tax the rich. Well, fine, we can argue about whether that should happen or not, but just say it's okay. But then it has to be inflation adjusted. We saw the thresholds for Social Security inclusion were for the rich people, and truly at the time you could argue that they were the affluent. Well, over the years it wasn't inflation adjusted, and slowly but surely it's gotten to the point where it's not only middle class, but lower middle class, okay, in terms of income.
Right.
And AMT was pretty much the same thing, and now the Obamacare tax at 3.8%, my understanding is that is not inflation adjusted. Quite a number of things were inflation adjusted along the way, and that's one of the legacies of the Reagan administration, is that they put inflation adjustments to all of these aspects that affect us.
Well, we're talking about the AMT now. There's really nothing, the average American's not going to have to really worry about this unless they're heavily involved in like municipal bonds or some other preference item. So really that's kind of, now that we got it done and you said we can plan for it, but when I'm looking at things like the AMT and the impact it can have on a client, especially, you know, high bracket, because now what are we looking at? $450,000 now for a married couple? You know, that's a pretty big number. And so are they going to be crossing into areas that we're going to, as planners, I guess I'm asking you, Ken, are we going to have to start thinking about AMT? We're going to have to start thinking about the higher ordinary income tax bracket. We're going to start thinking about, we're going to get to this in a little bit, capital gains, the new 3.8%. Some people call it a surtax. I don't know if that's even legitimate to call it.
Well, think about this. You know, you leave a $300,000 IRA to your son. Suddenly he pops $300,000 into his income that year, pops him into a much higher tax bracket than normal. And then all kinds of things could kick in: AMT taxes, reduction of exemptions, credits, deductions. It's not just the inclusion and the higher income tax bracket. Other devices, aspects of the tax code kick in. And so really it gets down to either use an advisor who's doing tax projections when you're expecting a large lump sum coming in, or, you know, find your own software and process it through and say, this is my normal information, and now this is changing. What does that do to my taxes?
Well, I have to tell you, just off, because I've been in this thing 30 years, Ken, we see clients who are never really categorized as wealthy Americans, who have a nice pot of money at the end of their life. Maybe, like you said, you're 300,000. So nobody's really doing any real planning to the next generation. They're just saying, my kids are going to get it. And time and again, when we're faced, we're looked upon as the product vendor. Now all of a sudden, time and again, what are we looking at? We're looking at a $300,000, a $500,000 inclusion into a son and a daughter. He splits it up, and now they're in a higher tax bracket because nobody ever did planning because they didn't say, hey, we're not big enough to plan.
Well, that's right. And the fact of the matter is, over years, we know how compounding works, and even a relatively modest income where you have a person who's really good at saving, putting money away on a regular basis can accumulate some pretty substantial net worth. I can tell you, I've had teachers who are wonderful that way. I had a family of 2 teachers, husband and wife, and they put that money away like crazy in those 403Bs over the years. By the time they got to retirement, you'd think they're wealthy. They had a lot of money at the time. And so these are people that we don't think of as being wealthy or rich, but they're really good at saving money. And you and I were just talking at the break earlier about the fact that the Roth IRA may be the place for low-income earner types of people that have low tax brackets, and the deduction doesn't do squat for them early on.
Right.
But later on, when they're taking it out, they may be in a higher tax bracket because of their success in life. And then furthermore, the distributions from a Roth don't count towards the taxation of Social Security. So, you know, that could be a wiser way to go.
And in the end of the week, Ken's going to explain. We've been looking at the math on the timeline on this, on tax deferral versus tax deduction.
Right.
There's some real value here, and I think we're the first ones to really talk about this on air. So don't forget, Friday's show is going to be huge on this. Now, we're talking about, I finally get done with the AMT. We finally got a fixture. We know where it is now. We have a pretty solid number. When we come back, I want to talk about capital gains, capital losses. We already touched on this a little earlier yesterday, but I want you to unfold it, and especially the impact of what we call, and it's Ken's patented line, the capital gain trap on Social Security. Unbelievable when you hear it. We come back from the break, more on capital gains and losses, part of our income tax planning for 2013 with Ken Davis. Hey, and don't forget to enroll in IULUniversity.com for the best training, education, and sales support when it comes to life insurance for retirement income.
You're listening to the insurance industry's #1 resource for products, planning ideas, carrier information, and interviews you can use. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Did you know the average 401k runs out of money just 7 to 8 years into retirement? Time Magazine, the Wall Street Journal, and many other publications have warned of the difficulty of saving with a 401k. But what if there was a way to create tax-free lifetime retirement income with no stock market risk? Good news, there is.
You know, living in fear of the next market dive is not the way I want to live my life.
Why would I go out there and take on risk when I don't need to?
I have a lot less stress knowing I can't lose any more of my retirement savings in the stock market.
Call now to receive your free, no-obligation analysis of what this retirement vehicle could do for you, a comparison to your current retirement plan, and a free video that explains this exciting opportunity. Start planning a retirement you can enjoy instead of worrying about future tax increases and stock market losses. Creating income that will last your entire life is the most important thing you'll ever do. Take control of your future. Call now for your free analysis, comparison, and video.
Well, welcome back to the Business Insurance Zone. I'm Steve Savant with Ken Davis. And remember, you can order today's materials at thebiz.tv. And while you're out there, click on the background technician icon for your free trial of your 30-day offer. You can access the best needs analysis and client education materials that address almost every area of financial planning. Remember, it's absolutely free for the first 30 days. I've been using it for almost 22 years. It's a huge, huge support for your practice. And by the way, it may keep you out of trouble with your BD. And before moving forward, speaking about that, before moving forward, anything we talk about on the show, especially on taxes, always consult your tax advisor and your broker-dealer compliance department before you use any of the material on our show. We're talking about capital gains and losses, part of our income tax planning series for 2013. Now, Ken, we talked about, and I don't want to get into the Social Security part first. Let's just do our straight up, here's capital gains. We just touched on it a couple days ago. I just want to be able to say, here's what we're looking at under the new tax. Here's what we look at. And what do we need to really focus on?
Well, 2013 introduces a new bracket for capital gains. It's now 20% for those that reach the 39.6% bracket, which I think is over $400,000 for singles and $450,000 for couples. And so we have that to contend with. We're going to talk about there's actually more to the capital gains tax rate than meets the eye.
Right. In fact, actually, one of the things that we talk about all the time, and this is a major revelation to the senior market, when we're talking with people with Social Security, Ken, as many of you know, Ken's an expert in Social Security planning, how to be able to really get all the value and benefit. Maybe we'll have to do a whole nother Redux show on that. But really, what we're really, I have to say, I'm kind of stunned at this, that we look at this thing called the capital gain trap for seniors. Now, before I get into it too deeply, capital gains, hey, we all know what it is. It's all going up for the higher bracket, wealthy American. We're looking at capital gains. I think most of us here, if you say, Steve, I need to have more information, I got a ton of information on basic capital gain and losses and harvesting it before the end of the year so that you can really kind of net out your gains and losses. But my more specific, I'm back on the Social Security, is that the trap comes into, we feel like, hey, I'm only paying 15%, the normal American, an average middle class, I'm paying 50% on capital gain, and then I go to my Social Security and I find out I'm paying a lot more than that.
Well, what's interesting is we've focused on the Social Security, but it actually affects adjusted gross income, which affects exemptions, credits, and deductions. The Social Security is maybe one of the more severe elements of it. But what we're talking about is when somebody says, well, how much am I going to pay? You call your CPA, I'm going to have $100,000 in cap gain this year long term. What am I going to pay in taxes? Well, the answer normally would be 15%. Well, now it may be 20% if you have other income. But there's actually two impacts. That capital gain you don't take 15,000 of the 100 or the tax rate and throw that into gross income on page one. You throw a whole $100,000 on page one into gross income, which flows down to adjusted gross income, which gets turned into modified adjusted gross income, which determines whether or not Social Security is going to be included or not at a 50% level or up to 85%. But furthermore, it affects AGI and modified adjusted gross income as to phase outs of exemptions, credits, deductions, potentially alternative minimum tax calculations. There's a whole bunch of different pieces to this. It's like this big machine, and when you get to this cog, it causes this cog to turn, that cog to turn, and suddenly you thought you're paying 15% in capital gains tax, and it forces other items to be taxed. So the effect of that is much greater. So you can't just assume all I'm going to pay is 15%.
Well, again, I think you're really bringing to the table full disclosure, because we're all sitting there saying, hey, I paid 15%, so here's my $1,500 tax, I'm done. But the actual gain, capital gain, if I understood you correct, is flowing, the whole gain, not the tax, the gain is flowing from my other calculations. Now, I find it almost unconscionable that we're talking about having an impact on Social Security. So I'm looking at 15% capital gain. $1,500 was all I was going to pay, and then when I bring this over for Social Security provisional income test, I'm now going to pay taxes on my Social Security because of this so-called capital gain.
Right.
And now it's getting so close to almost, if you did the equivalent on ordinary income tax, it's almost equivalent.
Well, it starts to push you into an effective rate that's higher, and this is one of my biggest concerns, and we can all argue who should pay what and what tax brackets and the rich versus poor, and that's all we hear all over the press. Forget all of that. Look at how does the tax law function, and can we understand the consequences of the choices we make? I mean, the government is supposed to use the tax law to provide revenue for the government, but we all know that they toy and monkey around with it to cause people to make certain business decisions and to function in certain ways and to benefit people with kids and with education credits and all kinds of things. Well, the fact is that's useless to us unless we can understand how it actually works. And it's so convoluted that that's impossible. And this is just one of those examples of we think it's 15% when in fact it's much greater.
In fact, actually, when we've shared this with many of our geriatric clients and seniors, they are just stunned that their Social Security is getting actually taxed based on, they thought, their stock portfolio, which is down at 15%. I mean, this is where you get into this disclosure. Who's really paying what? And actually, I love your point, Ken. It's well taken. We're not trying to take political sides on any of the economic issues. We're just saying you need to look at full disclosure. That sounds like the way you're explaining to me, Ken. Everything's correlated now. You can't do anything independent. I can't even sell off a stock piece, right?
That's right.
It's completely correlated. And when we go through the 1040, we're going through a gauntlet of our gross, a gauntlet of our AGI. Now we're doing modified AGI. Then my Social Security comes online for provisional income test.
AMT.
And AMT. When you think about all this, this is why we're talking about in tax time. If you're looking for opportunities to talk to your client about money, this is the time. Remember, you can watch our show by going out to our own website, thebiz.tv, and follow me on Twitter, Facebook, LinkedIn, Pinterest, and Google+. Well, that's the Buzz on the Biz for today. You've been in the zone, the business insurance zone.
You're listening to the insurance industry's #1 resource for products, planning ideas, carrier information, and interviews you can use. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.